Hi, this is Alan Gassman, and I'm here with my partners, Ken Crotty, Christopher Denicolo, and Brandon Ketron, and we are looking forward to explaining to you the new flow-through entity rules. We actually think we understand them, or at least most of them. So we welcome you. You should have gotten an email today with the PowerPoint and also with a copy of the actual statute, Section 199, 2 private letter rulings, and a partridge in a pear tree. If you did not get that email, let us know. We'll be glad to send it. But for now, what you're going to see is simply our PowerPoint. After this page, you will no longer see our beautiful faces, so say goodbye. And let me just mention here, as I try to turn the page, a few upcoming programs that you're welcome to attend. These are all free. Friday, March 16th, we're going to talk about hot topics for Florida lawyer ethical situations with Joseph Corsemeyer. That's going to qualify for an ethical hour for those of you who need one. And then I'm going to be at Heckerling presenting at the Veralytic booth for Barry Flagg on life insurance, and also at the Premier Trust Company booth to talk about differences between Florida and Nevada trusts, and at the Interactive Legal booth, which will be providing our Estate View software. So if you'd like to see me at Heckerling, I'll be there, or if you'd like to see me otherwise, just send me an email. Okay, let's talk about habits here. We're going to have to change some habits because the laws have changed, clients have changed, situations are different. So take a deep breath here and think about the new habits that we're going to have. Certainly one of them is going to be to analyze every single situation for a Section 199 opportunity and a Section 199 risk. The other big change is going to be retitling assets and reallocating assets between married couples relating to basis planning and estate tax planning, but that's not what we're going to talk about today. For those of you who are not up on the new tax law, I'm going to give you a little bit of background. Those of you who are up on the law, you might just want to watch these slides. You can feel free to use them for your own uses or to check your emails while I'm going through a little bit of background of what just happened. Everyone knows the estate tax exclusion went up to $11,700,000 per person. The gifting annual exclusion went up to $15,000 per person. They're re-examining these though because of the chain CPI measurements, so the exemption may actually be $11,680,000, but that would be trivia. The exemption goes back down to 1/2 in 2026, so we will have a webinar in 2026 to discuss this. If you sign up now, we'll send you a free book. Consumer Price Index now uses chained CPI. That's going to be a little bit less than CPI. We figure it's going to be about 0.2% lower than CPI, at least based upon the last 16 years. High earner families can now transfer ownership interests in entities back and forth. If they feel that they're not going to pass the $11,700,000 exemption and that their children won't, then why not move part ownership of an asset into a trust that your children can benefit from until they don't need the benefit anymore, if that's going to save a lot of income tax. So that's going to be a new habit for all of us. Tax brackets have changed. This is a unique chart at page 10. It shows you per $100,000 of income what the tax bracket is, and they are a lot lower for everybody. So you see the additional tax savings in the second to the from the second to the right at each increment of $10,000, and then in increments of $500,000 at the end. Feel free to use this chart. There's the single filer chart. It's an equivalent situation. There's the tax brackets for you. Capital gains rates are the same, but they don't pick up until a much higher number. So people are going to pay lower capital gains. You're not going to pay 20% if you're married until you reach $479,000 of income. So that's going to be interesting for a lot of people. The alternative minimum tax is continuing, and Brandon, am I correct that the 20% deduction under 199A is a tax preference item?
Right. You still get the deduction for calculating AMT, but it's calculated after you take your AMT tax, so you don't get the deduction beforehand in determining whether you're subject to AMT or not.
So you can't be so quick to tell clients that they're going to get a 20% deduction when the AMT may take that away. So there's a little bit of description of the AMT that I'm going to go ahead and skip. The child care credit is out there. It's going to save a lot of people a lot of tax money. The kiddie tax and the trust tax rates, let's memorize these. The income above above $12,500 ordinary income is going to be taxed at 37%. So it's no longer at the parent's rate for the kiddie tax. If you have a child who's under 19 or they're in school from ages 19 through 24, then they're going to be taxed at these high rates after they hit $12,500 of income. And so will trusts. Trusts are going to be taxed at high rates past $12,500 of income. That, of course, applies to what we call complex trusts, which can receive money and don't necessarily have to distribute the money. Again, we have the Consumer Price Index. The personal exemption is now at $4,050 a person, and it does not phase out with high income.
They actually eliminated the personal exemption. Previously, it was at $4,500 per person, but this is gone now.
See, it's hard to fool Brandon Ketron. Thank you for the save. Standard deduction is now $24,000 for married filing jointly, $12,000 for single. Itemized deductions chart, you're going to like this one. If it's in green, you still get the deduction as it was. If it's in yellow, they change that fellow. And if it's in red, they cut off your head. So you can just remember that, and we'll be glad to send this to you. It does match the Christmas colors. You can use it in December next year, or this year. Itemized deductions, we're not going to go through, but we do talk about them. Page 25, are you going to be in the habit of telling people to move to Florida? Because they're not going to have nearly as much income tax in Florida, especially since they've lost their out-of-state income tax deduction. Look at this California dreamer. After taxes, this was an 8% additional tax in California, 8.03. Now it's a 13.3% tax. That's an extra $5,720 per $100,000 of income to live in California. So that's why your clients are going to be thinking about putting together complex trusts outside of California that are not going to be subject to income tax. The NING is in Nevada, the DING is in Delaware. The swing is in South Dakota. So we have information on that we'll be glad to send you. Also, a lot of your clients are going to convert their second homes and third homes into rental properties in order to be able to write off the interest, to be able to write off the state taxes, and also possibly a flow-through deduction. I rent my office building on a triple net lease. I doubt that that is a trade or business that's going to qualify for the flow-through deduction. But if I rent my office out on a full maintained basis, and I even have a couple of sublets going on, and maybe even I lease my sign out to a comedy company, then I might be able to call my building a business or a trader business and be able to get a 20% deduction on the income that we otherwise receive. And I know my partners are really looking forward to paying more rent. So there's a lot of considerations here. I'll mention charity very quickly. On the charitable end, because it is an itemized deduction, you might consider having your complex trusts pay monies to charity, because that will, in effect, carry out the income without a threshold. So clients who otherwise cannot deduct their charitable deductions or have that limited maybe want to modify their complex trust to have the complex trust make the charitable payment. And alimony is not going to be deductible unless you're divorced before the end of this year. So you need to get filing that divorce petition. If there's any chance at all that you're going to be divorced and you're going to be paying alimony, go ahead and mess that relationship up and get that divorce finished before year end. We've got other things here that I'm just going to skip, but everything I just talked about is pertinent to the flow-through entity planning one way or the other. Page 35, the Medicare tax. If the shareholder in the S-Corp does not materially participate in the S-Corp, that 3.8% Medicare tax is applicable. If they do participate in the S-Corp materially, no 3.5% Medicare tax. So when you design these flow-through entities, you want to keep that in mind. It's different with partnerships, and it's more severe and more difficult to avoid that tax in a partnership situation, as we're going to review in a little while. Now, C corporations, the tax rate went down to 21%, but at the same time, those of you who are in Florida, we have a 5% Florida tax, so it's just a little bit under 25% total. It's not so good as 21%, and then you still have the 20% qualified dividends tax when you take money out of a C corporation. But there is a special kind of C corporation that you may not have to pay money to get out of, and that is the Section 1202 company. It has the same income tax bracket inside the company, but then there's an ability to sell the stock of the company and not pay any tax on the capital gain that otherwise would apply. So we're going to talk about 1202 companies because a lot of these activities you have, which may be flow-through entities, will be better cast as 1202 companies. And your corporate bracket here with a C Corp, it's a flat 21% tax, so people who were accumulating $50,000 or $75,000 a year in C Corps are now going to pay more tax, not less tax, which we thought was pretty interesting. You can convert a C Corp to S Corp to make it qualify for the flow-through entity, but then you have the Section 1374 unrecognized built-in gain rules. So you have to be very careful with respect to that. Okay, now let me go forward. Those of you who are not yet novices in this area, page 42, a C corporation is taxed at its own separate brackets. An S corporation does not pay tax unless in certain circumstances, if it used to be a C corporation, the income and deductions flow through to the shareholders pro rata. A partnership is also not taxed and has certain advantages and disadvantages as compared to S corporations, which we're going to discuss because they're very important. An LLC can be taxed as any one of these three entities or even the fourth entity, which is a proprietorship. By a proprietorship, I mean a business or a trade owned and operated by a single individual or by a married couple as either an active business, which goes on a Schedule C of their Form 1040, or as a rental activity, which would go on their Schedule E. So that's another background piece. And of course, when you have an S corporation, you have all different things that you can pay to get your income down. Your pension plan, your children who work, your wages, your dividends are not tax deductible at the corporate level, spouse on the payroll, paying rent. All of these things may need to be adjusted this year to take Section 199A and these other rules into account. Brandon, you want to talk just a little bit about the self-employment tax trap that we have for partnerships now?
Yeah, so generally, if you receive distributions from a partnership, those distributions are going to be subject to the employment taxes. And there's a couple of special rules and exceptions that might apply, but you could avoid those employment taxes, and we have those listed out there. Basically, though, if you are not a true limited partner in that partnership, meaning that you have no personal liability, you don't material participate in the entity, and you have no managing authority, then those distributions are going to be subject to the employment taxes.
So there are a lot of people out there who are partners in partnerships. They don't do that much work in the partnership. They don't receive that much compensation from the partnership. They receive K-1 income from the partnership reported to them. They're not paying employment taxes on it. And there are cases out there that we can send you information on which say that they should be. Whereas with an S corporation, your dividends, your K-1 should not ever be subject to employment tax. And that's really important. It's an important distinction that we all need to be aware of. And it's pointed out here on page 46. The Hardy case, the Melvin case, the Castiglio case, none of these were good for the taxpayers, and they have not been widely publicized. Okay, page 47. We're going to get started now. Take a deep breath. We're going to talk about the Section 199A deduction. And the basic concept here is that if you have a flow-through entity and you receive income through the flow-through entity, whether it's an S Corp or a partnership or a proprietorship, you have a 20% tax deduction if you qualify. It is based upon either 20% of what flows through or 20% of the individual taxpayer's taxable income. So it can't be more than 20% of your taxable income. In case you have losses, then you can't take the whole 20% deduction. And then there's certain limitations that apply if a married couple receives flow-through income and has more than $315,000 of net income, or the threshold is $157,500. And it has to be U.S.-based income. So that was the general situation, or that's what they're looking at. Now, Brandon, do you want to go through the definitions at page 48 that we're going to be using in this presentation?
Sure. So the statute refers to a 20% deduction on qualified business income, and that's generally defined as income that was received from a flow-through entity such as S corporations, partnerships, LLCs, disregarded entities, Schedule C and Schedule E entities, as long as that income is effectively connected to a U.S. trade or business. Now, there's categories of businesses that aren't eligible or are eligible unless their income exceeds at a certain level, and those are referred to as specified service trades or businesses, and we'll go through what those are in a couple of slides here. If your income exceeds those threshold limitations, which is the $315,000 mark for couples filing jointly, or $157,500 if you're a single filer, then there's also another limitation that applies based on the amount of W-2 wages that the entity pays or the amount of qualified property that the entity holds. And those W-2 wages are defined as compensation paid to employees of a flow-through entity, and it doesn't include wages earned by an individual taxpayer from sources other than the flow-through entity, or any compensation paid to independent contractors, and it also does not include guaranteed payments from a partnership, which are defined below there. And then qualified property, which is another part of that test, that's physical assets, which includes real estate, furniture, and equipment owned by the flow-through entity that hasn't exceeded its depreciable life. And we'll talk a little bit more about what that means later on.
Okay, so these are all definitions that you'll want to become familiar with. We're going to repeat them so you don't, it's not necessary that you have already memorized them, but they're all important components that go into this situation. Now, to avoid confusion also in this presentation and in this outline, the flow-through entity, where you measure how much flow-through income there is, we're going to refer to as the trade or business entity or the flow-through entity. On the other hand, that taxpayer who receives the flow-through entity by K-1 for an S Corp or a partnership, or by ownership for a proprietorship, we're going to refer to as the taxpayer. And for example, if John Smith is a taxpayer and he and a complex trust formed for his children are partners in a widget business, then John Smith and the complex trust are going to be called taxpayers in this presentation, and the widget business is a flow-through entity. So some of the tests apply at the flow-through entity level, and some of the tests apply at the individual level. Believe me, this is not so complicated. It's just a little bit hard to explain. Once you get your arms around it, you will understand this tax. So Brandon, do you want to tell us what page 50 is about?
Yeah, so there's a lot of questions involving if, since the C corporation rate has now changed to a flat 21%, are we better off converting to a C corporation since passive income or flow-through income is taxed at your individual rate, which is, could be as much as 37%. So we just kind of analyzed whether that would be the case or not, and we took into account that, in Florida, there's also the Florida corporate tax rate. So really the C corporation rate is 26.5%. And based on that, under a C corporation, if you get taxed at the C corp level and pay out the distributions taxed at qualified dividend rate, then your effective tax rate is really 43.99%, which is comparable to the flow-through rate of 37% if you receive no deduction, or even 29.6% if you do get the advantage of that Section 199A deduction.
So we're not getting real excited about C Corps.
Right.
A lot of people are, but we sure aren't.
And there's also Lineberg Information Services came out with an analyzer tool that is available for purchase on their website that does a really good job and goes into a little more detail than we did to analyze this C corporation versus throw-through entity tax rate.
Okay, so now page 52. If you could memorize page 52, you've pretty much got this thing wrapped. You know what a flow-through entity is, and you know what the taxpayer who owns an interest in the flow-through entity is. And you know that there's a 20% deduction, which will basically bring a 37% tax bracket payer down to 29.6%. You know the Medicare tax is in addition to the income tax. But then there's the two limitations that they put in there. Not everybody, not every business is going to qualify for this flow-through entity test. The first one, the specified service trade or business. If your flow-through entity is in certain trades or businesses, including health, law, and accounting, then you don't get this deduction unless the taxpayer's taxable income is under $315,000 for married or $157,500 for single. So let's be real clear on this. Let's say that you are a medical practice S corporation and that qualifies, but your income is over $417,000. You don't get any deduction if you are the owner of that practice. On the other hand, if you're the owner of that practice and you make less than $315,000 for all your countable income, not only from the practice, then you get the same 20% deduction that anyone else does. And if you're between $315,000 and $415,000 in income, then it phases out. And Brandon has a beautiful chart we're going to look at the phase out to see how bad that is. For single, it's at half these amounts, $157,000 phasing out to $207,500. So that's why it's important to know what a specified trade or business is. So that's the first limitation we want you to memorize when you're done with this conference today. The second one is the wages and qualified property test. So here's how this works. If you get income from a flow-through entity, and again, you make under $215,000 for married or $157,500 for single, then you get the 20% deduction regardless of whether the flow-through entity paid wages or had qualified property. But if you're a big earner, which means you make more than $415,000 and you're married, then if the flow-through entity does not satisfy either a wage test or a combined wage and qualified property test, you don't get the deduction. And your deduction, as we're going to discuss later, is going to be limited to 50% of the wages paid from the entity, including wages paid to the owner, or the sum of 25% of the wages plus 2.5% of the qualified property cost. We're going to go over that, but again, page 52, this is key. You're going to remember these are the two exceptions. You're going to remember that if it's a medical business and the client has over $415,000 of income, sorry, no deduction no matter what. If it's any other business and the client has more than $415,000 of income, no deduction unless you satisfy the wage, except to the extent that you satisfy 50% of wages or the sum of 25% of wages and qualified property. Okay, everybody who started the call is on the call. I'm very proud. Let's get creative right away, because we'll talk more about specifics, but let's rest the brain for a minute here. Page 53, you've got a medical practice owned by Dr. and Dr. X. They are married. They own the practice, whether it's an S Corp, a partnership, or proprietorship. Their children set up a factoring company. The factoring company buys their accounts receivable and pays them more than a normal factoring company would pay them. There's a legitimate business reason for factoring because then there's no accounts receivable at the medical practice level. The practice may have a lot of letters of protection where the doctors don't get paid until months, even years after they do the work. The medical practice company is certainly a company in the business of health that would be limited, but we don't know whether the factoring company would be limited. It doesn't seem to be within the definitions we're going to talk about. The factoring company may pay interest to a family limited partnership. So this is just an example of some of the structuring we're going to talk about. Another piece of structuring that we're going to talk about, page 54, you've got the medical practice, you've got the doctors on top. They want to get their income down. Their income's too high to be able to take the deduction. Well, are they paying enough pension contributions? Do you want to increase the pension if you can? Get into a defined benefit or a cash balance plan? Do you want to increase the doctor's salary? But if the doctor's the owner, that doesn't help you. You want to get the kids to start working, give them $6,000 in compensation. You pay $753 in employment taxes, and they set up Roth IRAs. Do you want to get the parents and your in-laws working? Get them some compensation to get the income down. And then this is really interesting. Do you want to give part ownership of the medical practice, which is permitted in Florida, to a trust for the children that can be taxed as a separate entity? And we're going to talk about the different types of trusts we can do. Or do you want to start paying a C corporation or an S corporation to do other types of activities that are not healthcare activities? For example, the billing company, a factoring company, a management company, an advertising agency. Would these qualify as non-health businesses, or would they be aggregated into a health business? And these are things we don't know the answer to, but these are the things we're looking at doing. So you can kind of keep this in mind while we continue to look at these rules. So Brandon, do you want to explain page 55?
Yeah, so we just took a quick look at, what is the possible cost of losing the pass-through deduction if your income is over this level and you don't take these opportunities to get it down below the level, easily, maybe contributing more to a pension plan or paying some of those salaries that Alan discussed. So if you don't undertake these planning ideas, it can cost you roughly $18,500 in taxes by not doing these things.
Just as between 315 of income and 415.
Right. So you can see on the bottom there, the effective tax rate on the first $315,000 of income is 23.99% if you don't take the flow-through deduction. But if you take advantage of that deduction, you're only paying 18% in taxes. So you can see the savings there.
And by the way, if anyone would like any of these in Excel, we can give them to you in Excel, and you can certainly play with them. So let's talk about this, Brandon. This is what happens in the phase out when you're from 315 up to 415 married. So you're telling us that the effective tax bracket for this income is on the far right. Do you want to explain this a little bit?
Right. So we just kind of looked at the effective tax rate, and we didn't really consider, what your standard deduction or other deductions might be in computing this, but we just wanted to compare apples to apples here. If you had $315,000 of income and were able to take the full $199 deduction, your effective tax rate is 20.62%. Now, if your income was increased to $365,000 and you're only able to take half of that Section 199A deduction because of the phase out, now your effective tax rate is all the way up to 24.45%. And if you're not able to take any deduction at all and you're all the way up at $415,000 of income, then your effective tax rate increases to 30.35%.
So it's really important, if you can, to get this thing down to 315, if it's at all possible, to reduce the taxes paid. Okay, so now memory time again. Page 57. These are the 11 categories of companies or businesses or flow-throughs that are going to be subject to the income limitation. Health, law, accounting, actuarial science, performing arts, businesses where the reputation or skill of one or more employees is an important part of the business, consulting, athletics, financial services, brokerage services, and investing, trading, or dealing in securities, partnership interests, or commodities. So these come from the Section 1202 definitions, which is interesting, because 1202, as we said before, was passed about 20 years ago, and it allows C corporations to be sold tax-free if you meet certain definitions. So I want to show you on page 58. On the left-hand side, I again have given you the exact 1202 items that you get punished if you are in these items at 1202. And on the right-hand side, on the left-hand side, these are the items you get punished for under 199A. On the right-hand side, these are the additional items that will not be allowed under 1202. Engineering and architecture was most notably taken out at the last minute from the 199A rules. I don't know what the engineers and the architects did, but I guess because they're construction related, they were able to get that in that. But let me ask you something. If you're an engineering company and you are named for the name of your main engineer, and your principal asset includes reputation or skill of that engineer, you may still have a 199A issue. We don't know the answer to that yet. But these are, these are the categories of services, and this is where the game playing is going to be made. I mean, the football team, they are in athletics, but is the gift shop of the football team in athletics? Is the restaurant of the football team in athletics? Is the billing company and management company that the football team pays to affiliates in athletics? That's where regulations are going to be very interesting. Now, there are two private letter rulings from the 1202 days where a company that did research on drug formulation and actually tested drugs was not a health company. So that's pretty good. So there may be some real hope there for the health industry. And then also a laboratory reporting company that did not diagnose or recommend treatment was ruled not to be in the field of health. So these are the only 1202 guidance that we have, and they're only private letter rulings. They're not binding on the IRS, but it is useful to know that we have the ray of hope. Brandon, you want to briefly review what David Kirk told us yesterday? David Kirk of Ernst & Young wrote the Section 1411 regulations and is really the most knowledgeable person in this area that I'm aware of.
Yeah, so he, kind of mentioned to us that this might actually track when 199 was actually issued and kind of the same timeline there. So the IRS may issue notices as early as the spring of 2018, and they may have new forms and instructions in the fall of 18. Now, it's important to be able to get these things out, especially the forms and instructions, because the tax software programs need this guidance so they can make their software and get that out to the purchasers of that software before tax returns are due. Now, he did tell us that these notices and forms instructions are going to be extremely basic. He'll call it right down the middle of the fairway is what he said, and they're really unlikely to address any of those complicated issues that we just talked about. In the regulations, they could take years. We don't know how long it's going to take, and some other higher priority items might take precedence over the 199A regulations. And then he also made us aware of this new penalty threshold that could apply if you take a 199 deduction. Even if you take just $1 of a 199A deduction, your threshold for substantial underpayment of taxes decreases from 10% all the way down to 5%. So it's cut in half if you take a 199A deduction.
And that's really, really punishment. That makes no sense at all. So that somebody was really thinking about abuse when they set the statute up. And we've got David's email address there. We thank him sincerely for the time he spent with us yesterday. We're going to be writing up an interview transcript from that call yesterday, and we'll be sharing it with you in the next day or two. Okay, the wages and qualified property test. I think most of you are aware of this, but the maximum deduction, if you're a high earner taxpayer, is going to be based upon the entity, 50% of the entity's W-2 wages, or the sum of 25% of the W-2 wages plus 2.5% of the unadjusted basis. We're going to talk more about this later in actual examples. But in a lot of situations, clients are going to need to pay wages where they've not been paying wages before. There is an example on page 62 where if you were not paying wages whatsoever, you've got to have a certain amount of wages, and you may need an actuary to calculate this, and you'll be calculating how much the wages impact your pension plan, how much more the pension plan contribution is going to be so that you can back into how much the wages have to be. And again, wages paid to the taxpayer who's taking the deduction, and also wages paid to everybody else. So this is a nice situation where you can deduct U.S. wages, but not foreign wages, because foreign wages would not be part of the U.S. trade or business. So this may create a few jobs. It's certainly going to create jobs for accountants and actuaries who have to figure this out. and for tax lawyers who have to defend clients when the IRS challenges these things. It's all very interesting. Brandon, page 63.
Yeah, so there was an article published in Forbes, and the name of the author escapes me, but he actually analyzed what the most efficient ratio of wages to non-wage income would be to meet and satisfy this wage and qualified property test. Now, if you're subject to this test, then your wages need to be at least 28.57% of your flow-through income to maximize the deduction under Section 199A. Now, if you're taking the 25% of wages and qualified property tests, you might be able to pay a little bit less in wages depending on the amount of qualified property you have. But that's an example of how that might apply.
Right. So we all know, or a lot of us know, that the taxable income for the taxpayer is the gross income minus above-the-line deductions, less the standard deductions or itemized deductions. That gets you to taxable income, and then 20% of taxable income is the other ceiling on this deduction. And we've got slides here for that, and we actually, Brandon took a tax return from 2017, and he's shown you where these things get changed. So now, qualified business income on page 68, I think we've said this pretty well, and what we don't know is what the definition of a trade or business is going to be. Those words are used all over the Internal Revenue codes in all different ways, and there's no one definition. But if you have a client who triple net leases their office building to their medical practice, that's probably not a trade or business. But a full management lease may be a trade or business, and we won't be sure till maybe next year. But go ahead and change that lease from a triple net lease to a fully managed lease and get some activity going, and then we'll wait, and next year we're going to know whether there's going to be a deduction. We're not going to know this year. We'll be lucky if we know at the end of this year, when TurboTax and the other people need to know from the IRS what the middle of the road positions are going to be. Here's a big trap on page 69. Wages are only counted if they're reported within 60 days properly to the Social Security Administration. So this is not a situation where you're going to be able to say, oh, let's reclassify what I've been paying as dividends and distributions all year. Let's call them wages. And under the partnership tax law, you cannot pay wages to a partner in a partnership. Those are called guaranteed payments, and it's unlikely that they will qualify as wages under the test. So what you may want to do earlier rather than later on page 70, if you have this partnership, and the partnership is going to be making distributions to John Smith, and you need to call them wages, then John Smith should no longer be a partner. He can go ahead and transfer his partnership interest into an S corporation, and then the S corporation can receive distributions, and then I don't think John Smith is a partner anymore. So then he can receive a W-2 wage, or at least arguably he can receive a W-2 wage. But if his pro rata share of partnership liabilities exceeds the tax basis of the partnership assets, then you're going to trigger income tax when you make this contribution. So you have to do this very carefully. By the way, I forgot a slide. One of the first slides we were going to put on is you always have to confer with the certified public accountant who's going to do the tax return before you make any recommendations in this area. It's just not fair otherwise to anybody. And this is difficult enough without us all working as a team. Page 71, just don't forget the family limited partnership rules. They apply here. If you transfer a partnership interest to somebody and you expect that to be considered as owned by them for income tax purposes, then capital has to be an important part of the partnership. It has to be a principal asset of the partnership. It can't just be a services partnership. And you also have the 704B2 substantial economic rules. So I just wrote an article on this specific subtopic with Marty Shinkman and Jonathan Blockmacher, and if you would like a copy of the article, please let me know. By the way, we're going to go well past 12:45 here, or well past 5 here, and I apologize for that, but anyone who signs off, we will send you a transcript of everything we say after the 45-minute mark. And we also have some questions and answers that have come in that we're going to go ahead and make sure we answer. So now, what is qualified property, and why is this as important? Well, as you know, at the last minute, the real estate industry was saying, wait a minute, we don't have much in wages. We're not going to have much of a deduction for our high bracket taxpayers. You've got to give us something. And what they gave them for President Trump and Senator Corker and others, many of our clients, is that you can count up to 25% of the wages plus 2.5% of the cost of depreciable property that is either still in service or no older than 10 years. So if your client bought a building 28 years ago for $1 million and the land was $200,000, and the $1 million building is almost completely depreciated, you can count 2.5% of $1 million towards your ceiling. Now, once that building goes past its depreciation period, then you can no longer count it anymore. And if you've been taking component depreciation on buildings, you bought a building 9 years ago and you did component depreciation. So instead of depreciating $1 million building, you depreciated $8 million of building and $200,000 of components. You're not going to have those components to include in the 2.5% test after the 10th year. That's just the way this works. Brandon, anything to add to that?
Yeah, I think you hit it perfectly.
And if you exchange a property, if you do a 1031 exchange of a property for another property, you're probably going to be stuck with the original useful life and the original cost. But the regulations aren't out yet, so some people may consider 1031 property to cost what it actually cost at the new closing. And that's going to be somewhat aggressive with the overstatement penalty that we spoke about and we'll be talking more about. Then we have this simple chart on page 74 that Brandon came up with. Brandon, you want to tell us a little bit about this chart and why people should never leave home without it?
Yeah, so this is basically just the 199A statute we tried to get it on one page. So you can see just kind of if you start on the top left, you can just work your way through the flow chart and determine whether you're eligible for the deduction, if the deduction might be limited, or if you can just take 20% of your qualified business income and that is your deduction. So
everything we're aware of from a mechanical calculation standpoint fits in this chart, which is really good news for us. Page 75.
Yeah, so just, as a quick example, let's say that you're a doctor and you have income from your medical practice of $200,000 and you receive a salary of $100,000. So your total taxable income is $300,000. So you are going to be, starting on the top left, you are going to be one of the specified service trades or businesses. So you drop down a box, but your taxable income is not going to exceed the $315,000. So your deduction was then equal to 20% of your flow-through income or 20% of your taxable income less net taxable gains. So in that example, the doctor made $200,000 of income multiplied by 20% would be a $40,000 deduction that he would receive under Section 199A.
So page 75, tear this off, put it in your purse, put it in your wallet, look at it several times, and it all will come together and make good sense. Page 76, just a printout from the Lineberg 199A analyzer tool. Page 77, a reference to the article we published last Thursday in the Lineberg directory. We're in the process of annotating and improving that article with suggestions that we've received from Marty Shinkman, Jonathan Blottmacher, and David Kirk. If you'd like an updated version of the article, let us know. The article is absolutely accurate for every purpose as far as we know, but there's certainly things that we can add. Page 78, we can't take this lightly. It's great to be aggressive and save people a lot of tax money, but this substantial understatement penalty is 20% of the understatement with a very small threshold if you use this statute. So we have to warn clients to put the money away that they save, plus more, for 3 years after the return is filed. If they're not willing to do that or they're not able to pay the tax that you would be saving them, you've got to think about whether to walk away here. In addition, the statute does authorize the Treasury Department to issue regulations, and these will be legislative regulations on certain aspects of this, including manipulation of depreciation periods, short year planning, and determination of unadjusted basis. So we are going to have to be very careful. And I doubt that we're going to get regulations, maybe ever. We may never receive regulations under this section. I doubt that the Trump administration is in any hurry to give us regulations that would shackle any taxpayers. So we may just be stuck with what we are doing here. So, Chris, do you want to talk about page 79, which would be giving or selling part of a flow-through entity to a complex trust for children and grandchildren?
Yeah, interestingly, the threshold amounts of $315,000 and $415,000 are not prorated for complex trusts, even though the complex trust tax brackets are compressed, so that the highest bracket is reached at around $12,500. So what you can do is gift or have transfers of ownership interest and flow-through businesses to complex trusts in order to cause some of the income to be taxed under the complex trust system, and therefore being removed from the calculation of qualified business income of the taxpayer. That way, if you're getting close to those thresholds of $315,000 or $415,000, you can kind of reduce that by giving ownership interests to these complex trusts for children or other generations. Now, the important thing, of course, is whether you have an S corporation or a partnership, because if it's an S corporation and you're giving ownership to a complex trust, you have to make the trust become certain kind of classified trust, such as an electing small business trust or an ESBT, or a qualified subchapter S trust, which is also known as a QSST. And we have some more detail about that a little bit later on.
So at page 80, I simply show Dr. Doe. Dr. Doe's married, has a $125,000 salary, $425,000 of total taxable income, so there's no deduction. But what if Dr. Doe puts half of the medical practice into a complex trust that would be taxed for the children, and then the complex trust will have tax and the deduction, and Dr. Doe will have the income and the deduction. So it almost makes sense if you think about it at page 82. If Dr. Doe wants to put children 1, 2, and 3 through college and hasn't funded college yet and needs $200,000 each to fund college, why not set up complex trusts, gift part ownership in the medical practice to the trusts, and then when the trusts have received a total of enough needed to put the children through college, we stop. Dr. Doe buys the interest back from the complex trusts, or possibly even the complex trusts dissolve at that time. You just have to decide whether the income tax savings here outweighs whatever capital gains tax the complex trust may have selling the entity back. So this can be useful. By the way, I see an error on page 81, and that is I don't think we can have a complex trust for wife and children funded by Dr. Doe.
Well, not
or can we?
We can have the trust provide that an adverse party must consent to any distribution to the wife. That would move it from the auspices of the grantor trust rules.
Okay, so in this situation then on page, where was I? I'm sorry. On page 82, these 3 trusts could each be for the spouse and the children, and then after the trust is well enough funded for the child's college, the trust is also for the spouse and could release the remaining interest back to the spouse, so no more goes into the complex trust at that time. That would work well. That would save 10% of the income that goes into those trusts. And of course, those trusts could then invest in 529 college savings plans and receive tax-free income on their investments and put those kids through college. If this is a Florida medical practice, you are able to have the stock owned by spouses and by trusts for spouses and children, but not grandchildren. If you have a Florida medical practice owned by a trust that benefits anyone but the doctor's spouse, and the doctor's children, then the practice has to register under the Clinic Act, which is usually not worthwhile. So Ken, do you want to talk to us a little bit about electing small business companies?
Sure. Electing small business trust, or an ESBT, is a trust that's allowed to own S corporation stock. One benefit of an ESBT is that the ESBT can have multiple beneficiaries, so you wouldn't need to have several trust like we had seen on the last slide. If a ESBT is treated as a grantor trust, meaning it's treated as owned by the grantor for income tax purposes, then it's treated as a normal trust for income tax purposes. The downside of that is that you wouldn't be able to get the separate deduction for the trust. So if the ESBT is treated as a complex trust, then the one downside of having an ESBT as a complex trust is that all the items of S-Corp income are taxable to the trust at the trust highest bracket, regardless of whether they're actually distributed out to the beneficiaries. You don't get the D&I distribution that you normally would.
But we think that an S corporation K1 income to an ESBT, which is a complex trust, would qualify for the deduction if the trust has less than the income threshold.
Correct.
So it can still be a great planning tool. And then after the grantor's death, as you see here on page 84, the S corporation income again is taxed at the highest bracket, but we think the flow-through deduction would apply.
And another neat thing with ESBTs under the new tax law is that you can now have non-citizens as beneficiaries of the ESBT. If the ESBT owns S corporation stock, indirectly those non-citizens can be S corporation shareholders, which was not the case last year and before that.
Right. And the other nice thing about the ESBT is that if the S corporation makes a charitable deduction, the K1 comes through to the ESBT instead of the individual shareholder, and the ESBT can do the charitable deduction without a standard deduction issue, assuming that the ESBT has enough other income to satisfy the 60% thing. So I think ESBTs are going to be a lot more popular, and they're going to have to be well understood by those of us changing habits. Okay, Ken, what about the qualified subchapter S trust?
The qualified subchapter S trust is treated as more of a traditional flow-through trust, meaning that any of the S corporation income attributable to the ownership of the trust will pass out to the beneficiary. Benefit of that is because the beneficiary is deemed to be the owner of the trust, it seems as though the deduction limitations would apply at the beneficiary level instead of at the trust level. One downside of a QSST is that you can only have one income beneficiary during the lifetime of the beneficiary, so you would need to have separate trusts for each child in the example that we talked about. And a second potential downside for a QSST is that the fiduciary income has to be distributed out to the beneficiary. So if you're concerned about the beneficiary being a spendthrift or having some creditor issues, you might need to look at some way to secure the stock in another manner.
Okay. And, slide 87, we have that type of approach where you can have the income passed out to an LLC that is treated as owned by the child who's the income beneficiary of the QSST, and have that LLC managed irrevocably by the parent or some other trusted individual.
So here on slide 87, we see an LLC. Dr. Doe gives part ownership to the qualified subchapter S trust. The qualified subchapter S trust, if and when it receives distributions from the flow-through LLC, is required to transfer it to the child. But instead of going directly into the name of the child, it can go to an LLC owned by the child, which is disregarded for income tax purposes, but controlled by mama and papa. So the child will do exactly what the child is told to do with that LLC if the child doesn't want to be kicked out of the family, and then that LLC could be used to pay for college expenses. And then if you didn't want all the distributions from the flow-through LLC to actually go out to the child or the child's LLC, you could set up a blocker LLC. So in other words, the QSST trust for child one would own another LLC that would be disregarded for income tax purposes and would in turn own the ownership interest in ABC flow-through. So ABC flow-through would pay the money out to the blocker LLC, and the QSST would not have to pay the money out until it received money from the blocker LLC, in the same way that we do these for charitable remainder annuity trusts. So this is all new planning, very interesting planning. And who's going to talk about the 678 trust?
Yeah, this is another kind of trust that's allowed to own S corporation stock. Under 678 of the Internal Revenue Code, if you have a trust that gives the beneficiary the power to withdraw assets, then that beneficiary is considered to be the owner for income tax purposes. Additionally, under that section 678, if the beneficiary has that withdrawal power and it lapses or is released by the beneficiary, and the beneficiary has other powers that are grantor trust powers, then it's still going to be considered to be a 678 trust that's owned by the beneficiary for federal income tax purposes. Now, if the amount of the lapse is no more than the greater of 5% of the trust assets, or $5,000, you're not going to have a gift on funding by the beneficiary, which can be useful for asset protection and estate planning purposes. But if it's over that amount, then you might have a deemed gift by the beneficiary who releases or lets the power lapse, which can be an important consideration, not necessarily fatal, given that you can use an incomplete style gift trust here, as shown on slide 90, where you have an asset protection trust where father places $100,000 of S Corp stock into the trust. Son has 60 days to withdraw all of the assets, and the income will then be taxed to the son based on that withdrawal power, and the son will be considered as the owner for federal estate tax purposes and federal income tax purposes.
So I'll give you another example. Page 91, you want to buy a house for your child to live in, but you don't want to see it lost in a divorce or otherwise. You set up a 678 trust. You put $300,000 into the trust. The child has 30 days to withdraw it. The child doesn't withdraw it. The trust buys a house for the child. The child is considered to be the owner of that house for income tax purposes. And then when the house is sold at a gain, the $250,000 capital gains tax exclusion works. The child might decide to release any right to be a beneficiary of that trust, in which case the trust would then be owned for the grandchildren, the equivalent of a generation skipping exemption trust, but taxed to the child for income tax purposes. The big disadvantage of the 678 trust example that I just gave you is the child is considered to have made a $295,000 gift to the trust. That was a big problem back when the estate tax exemption was $1 million, a lesser problem at $5 million, and a much smaller problem now at $11.7 million. So the 678 trust is certainly a good candidate to own S corporation stock or partnership interests to enhance the flow-through income considerations. So, Brandon, do you want to talk about slide 92?
Yeah, so one of the planning ideas here, if you have a practice that is a specified service practice, such as a doctor or a attorney or an accountant, and you're limited on the deduction you can take if your income exceeds a certain level, is what can we separate and pull out from that practice that would be then eligible for the 199A deduction and is not a specified service trader business. So those are all things you want to think about when you're going through these planning ideas. And on the next slide, what Alan previously talked about is we can pull out maybe a factoring company or a billing company or a management company that may not be subject to those limitations and eligible for the full Section 199A deduction.
Like one item that we're structuring right now for a client is he has a very successful business, and his daughter is a very successful account representative as an advertising agency. So she's gonna have her own advertising agency. It's gonna be a 1202 company, a C corporation, and it's going to receive advertising revenues from the client's company, and then it's going to invest those revenues in billboards because the family really wants to invest in billboards. And then eventually that company will be sold to a billboard company at no capital gains, at zero tax. So the sky's the limit here. If you want to set up an IT company, if you want to set up a management company, there's no regulations out that says you can't. There's no aggregation regulations. So, but it needs to be real in substance. It needs to be absolutely real. It can't just be some book entries and a checking account that receives a couple of checks. It needs to be the real McCoy. And it's going to impact your lease, your wages, and other things like that. Slide 96 simply discusses the new parent F reorganization, which would be a way for you to combine two entities under a new parent S corporation if you need to put entities together for flow-through tax purposes. A lot of clients have separate entities where there's not enough wages in one entity, but there's too much wages in the other. We may have to put those together under the same cover, but maintain the separate identity, but have one tax ID number. So the F reorganization may come in handy. Page 97, we've talked about increasing pension contributions to reduce taxable income. That can make a huge, huge difference. Reevaluating year-end wages and dividend situations, moving income into C corporations, and paying deductible expenses to other companies. the 1202 company, which we've talked about probably plenty now, and then the new 179 deduction. Just buy a big piece of equipment. That may put you underneath the 307 or the 315, at least for this year. So just the process of buying a new equipment, or even having the government subsidize your new Escalade or your Porsche or your Mercedes. So all of these things, the depreciation provisions, should not be overlooked. And I'm tickled by the fact that the government is rewarding us for buying vehicles that get 18 miles to the gallon, but I guess that's the government for you. Non-residential real estate depreciation. Do you realize that a commercial building roof is now going to be completely tax deductible under 179? So a medical practice that needs a new roof may want to put the building into the practice under a separate entity. I mean, these are things, and I'm sure there's going to be mistakes made as a result of these types of situations. Increasing the rent, even though you do have the Florida 6.8% sales tax, which was a 7% sales tax, you may want to increase the rent if you're going to get a 20% deduction from a real estate business. You may want to have the doctor's spouse become a real estate professional so that you can release the 469C losses and have an active business. So all of these things have to be considered and can be considered in planning for clients under the flow-through entity rules. So Brandon, do you want to field some of these questions that came in?
Yeah, so one of the questions we had here is if we had a doctor who was married and was earning $800,000 in W-2 income from a clinical service or his medical practice, but then had a separate entity that was a non-healthcare entity that was earning $75,000. Now the question was, is he eligible for the qualified business income pass-through deduction on that separate entity earning $75,000? And we think the answer is yes, he is, because these limitations are applied at an entity level. So while the medical practice is not eligible for the deduction, the non-medical practice is eligible for that deduction. So that's what we talked about when you can separate out the specified service businesses from non-specified service businesses. But the only catch there is, since he's earning high income from the medical practice, the other entity is going to be subject to the W-2 wages and the qualified property test. So those tests will have to be satisfied in order for the doctor to be eligible for the deduction on that non-healthcare entity. Another question we had here is if the doctor is earning $300,000 in the practice, which is a healthcare industry, and the spouse is earning $100,000 from another job, which is outside of those specified service industries. Can he also take the deduction on the spouse's W-2 income from a separate service business, or can he also still take the deduction if the doctor still owns that second practice that is a non-healthcare industry earning $75,000 of income? And the answer is yes, the doctor can take the deduction on the separate practice that isn't the healthcare industry, and the spouse can also, or them together as a married couple filing jointly, will be able to take a deduction on the portion of income flowing through from the spouse that is not one of those specified service trades or businesses.
Last question.
Here we go. For the bonus round, it says, does establishing a complex trust help in any of the above scenarios in providing tax savings? And yes, it does. As we talked about earlier, the complex trust can be established for the medical practice entity to separate that income into two separate taxpayers, so it can be effectively split in half or in any proportion as you want to make sure you fall under that 315 limit.
Okay, so we're going to call it a day here. We have really appreciated the opportunity to share this with you. Brandon has probably worked 150 hours on this, on our article, on our outline and everything else, and we're not done. We're not nearly done. We're going to continue to follow this and make sure that we integrate this into our practice. We hope that you have a great day. Please continue to email these questions to agassman@gassmanpa.com, and may the rest of your afternoon be billable.